Good afternoon, everyone, and thank you for joining us on this call to discuss the financial results of Apollo Hospitals for the first quarter of FY19, which were announced yesterday. We have with us on the call the senior management team comprising Mrs. Sunita Reddy, Managing Director, Dr. Hari Prasad, President of the Hospitals Division, and Mr. A. Krishnan, Chief Financial Officer. Before we begin, I would like to mention that some of the statements made in today's discussions may be forward-looking in nature and may involve risks and uncertainties. For a complete listing of such risks and uncertainties, please refer to our investor presentation. Mrs. Reddy will briefly cover the operational progress and financial performance for the quarter, following which we shall open the floor for Q&A. Before I hand over, would like to just remind everyone that documents relating to our financial performance have been shared earlier, and these are also available on our corporate website. I now invite Mrs. Sunita Reddy to cover the highlights of our performance for the quarter. Over to you, ma'am.
Good afternoon, everyone, and thank you for taking time out to join our call on this Saturday. I trust all of you have been able to refer to the earnings documents that we shared. We are pleased to report a strong start to fiscal 2019, with the first quarter's performance clearly demonstrating increasing growth momentum and, above all-around operational improvement. All of you are aware that as we entered the fiscal year, we were impacted by a combination of government regulation on stent pricing and knee implants, followed by GST implementation, alongside the investments we made in ramping up medical teams at both new and established centers. As we transition from those headwinds, we had committed to deliver on both top-line performance and enhanced margins. It is clear from this quarter's numbers that our strategy around service pricing as well as cost optimization has begun to show results. Mature hospitals' EBITDA margins have improved from 20.4% in quarter one last year to 20.6% this quarter, an increase of 118 basis points. We stay committed to continue on this trajectory to further improve these margins over the next quarters. We have also begun to see an increased offtake of assured pricing plans across units and believe that this, while providing certainty to patients on costs, also recognizes the intrinsic value of the undelivered service itself rather than individual inputs. We continue to drive case mix calibrations with a focus on moving from volume to value, as this has predicated our strategy of enhanced focus on COEs. We have made significant strides in elevating clinical differentiation in transplants, neurosciences, and orthopedics in the recent months. We have successfully commenced the transplant program in Vizag, Nashik, Trichy, and Nellore, and completed 1,500 bone marrow transplants in our oncology COE. We have extensively leveraged digital and AI capacity to sharpen and nuance our clinical offerings and are well differentiated in the market. We have launched a global online clinical opinion service for cancer patients, which will be empowered by AI as well as the inputs of expert Apollo clinicians. We will intensify our efforts towards building strong COEs with a comprehensive approach encompassing ramping up medical teams, clinical pathways, and the latest technology, both medical and digital, and remain focused on growing complexity and quality of our clinical work, volumes, and revenues. The other aspect of our business improvement plan is cost and efficiency. The initiatives towards design to cost and cost optimization are progressing well in both our flagship units of Chennai and Hyderabad. The outcomes of these initiatives, we hope, will lead to protocols and pathways that will enable us to be competitive at multiple price points and open up new possibilities given the developments across the landscape in healthcare inclusion as well as regulatory interventions. Alongside these initiatives, we are prioritizing asset utilization and improving system efficiencies. Here too, we are heartened by the initial results. Against this backdrop, I will run you through the results of the quarter, which we believe reflects the resilience of our business model, which is well diversified across specialties, geographies, and maturities. Standalone revenues grew at 16% on a year-to-year basis at 1,910 crores. Within standalone revenues, healthcare services grew 12%, driven by volume growth. New hospitals reported 23% year-on-year revenue growth at 212 crores, aided by volume growth, while existing hospital revenues grew by 10%. Standalone pharmacies reported 20% growth this year. Q1 FY19 EBITDA was at 227 crores as compared to 173 crores in Q1 FY18, growing by 31% over the same period the previous year. Healthcare services EBITDA grew 31%, aided by positive traction in new hospitals EBITDA. New hospitals reported a positive EBITDA of 10.8 crore in Q1 compared to a negative of 8.7 crores in Q1 FY18. This is after absorbing the Navi Mumbai loss of rupees 1.6 crores. On the operations front, overall occupancy across the group was at 65% for Q1 FY19. The occupancy in mature hospitals was at 67%, new hospitals at 62%. Our loss was at 3.92 days compared to 3.91 days in the same period. ARPOB in Q1 19 improved by 4% to 33,715. AHLL business delivered a 24.4% growth in revenues for Q1 FY19. Now to give you a brief overview of the region-wise performance. Tamil Nadu revenues grew by 13%, aided by inpatient volumes growth. ARPOB grew by 6% to rupees 43,391. Overall occupancy in the cluster was 56% at 1,188 beds compared to 1,120 beds last year. AP Telangana region revenues grew by 7%. IP volumes grew by 4%. ARPOB to 31,694 was higher than last year by 7%. Overall occupancy was at 60% at 810 beds versus 805 beds last year. Karnataka region recorded promising revenue and volume growth. Malleshwaram recorded IP volume growth of 29%, while Bangalore and Jayanagar grew by 11% and 12%. Occupancy in the cluster was at 72% at 511 beds compared to 500 last year. Standalone pharmacies, SAP revenues grew by 20.1% year-on-year. On a GST adjusted basis, the growth was 26%. SAP EBITDA grew by 30% to 41.7 crore in Q1 FY19. EBITDA margins were at 4.7. As more stores within the network gain maturity and break even, we expect EBITDA margins to improve further. We have added 64 stores net of closures this quarter. We plan to build on this momentum in order to further enhance our dominant presence pan-India with the aim to be the undisputed leader in this space. Even as the market share of the organized pharmacy chains in the domestic industry is still minuscule, the ROCE in this business is now over 15%. Q1 FY19 standalone PAT increased by 71% to rupees 60 crore year-on-year, as interest costs increased by 12% year-on-year to 62 crore, depreciation 12% to 72 crore on account of additional capex in the new facilities. The effective tax rate for Q1 FY19 was 36% on account of a one-time provision of 4 crore relating to a prior assessment year. Adjusted for this, effective tax rate would be at 32%. The present net debt as of 30th June 18 is rupees 2,864 crores. We are happy to announce a partnership with a strong clinical team by way of an acquisition of a 50% equity stake in the 330-bed Medic Super Speciality Hospital in Lucknow, which will be operational in November. The acquisition will help Apollo take pole position in UP, Bihar and Jharkhand, all very promising and underserved markets, and consolidate our position in North India. We believe the elements of our strategy are well in place as we look ahead to the rest of the fiscal. We are well capitalized for growth. Of the total 7,000 plus operating beds, excluding AHLL and managed beds, that we have group-wide, 13 hospitals with over 1,650 operating beds are new, and increased occupancy in these will deliver an uptick in our volumes and top line. There is also a room for an incremental occupancy of up to 10% in our mature units. This will drive operating leverage and margin expansion as fixed costs have already been absorbed. And when combined with our extensive efforts on cost optimization and efficiency improvement, we will be able to deliver healthy EBITDA growth outpacing top-line growth. Given the conclusion of our current CapEx cycle, we expect to generate robust cash flows, which will then allow us to focus on the next aspect of operational strengthening, rationalizing the leverage on our balance sheet to strengthen the organization for the next round of initiatives. It is our strong belief that we have built the most diversified and responsive business model, and we see this borne out in the dynamism and adaptability we have displayed in a very challenging and changing external environment. We have made the internal changes we needed to position ourselves strongly to leverage the tailwinds from the sector, from local demand, the rollout of NHPS, and from increasing numbers of medical value travelers. We remain quietly confident about our prospects in the quarters to come. I now open the floor to questions. Dr. Hari Prasad, Neeraj Kar, and Krishnan are here with me to take your questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. Also, as a reminder, in order to ensure that the management is able to address questions from all participants in this conference call, please limit your questions to 2 per participant. If you have any further questions, you may come back for a follow-up. The first question is from the line of Sayan Mukherjee from Nomura. Please go ahead.
Yeah, hi. Thanks for taking my question, and really compliment for the detailed earnings update that you put up. My first question is on the Lucknow acquisition, around 90 crores for your stake. What additional investments would be required? And if you can share some expectations on ARPOB margin over a period of time from that hospital, please.
In terms of additional investment, no other additional investment is required into Lucknow because this is looking at it as a fully operational. This is the amount of capital that is required.
And even, this is taken care of even for the initial first year loss funding, which will be a small loss, which will be there in the facility. With that said, also the facility will be beginning with a set of doctors because, this has been built by a set of doctors in Lucknow itself who are doctors of repute, including the cardiologist, internal medicine, emergency care. All of this is kind of already been taken care of. The ARPOB that we expect in this facility is around 18 to 20,000 in the next 18 to 20,000 as we start, and moving up to 25 to 26 in the next 2 years.
Okay, thank you. And my second question is on AHLL. There seems to be some improvement that we are seeing. Particularly if you can give some details on diagnostic business, which seems to have seen a significant expansion. How should we think about margins here? Because typically we see margins in diagnostic business north of 20%. And secondly, on your specialty care, Cradle and Spectra, again there seems to be some improvement. If you can throw some color on occupancy there, and how should we see this segment improving over the course of the year, and overall your guidance for break-even at the EBITDA level for AHLL. I think you mentioned first half of next year. Is that something which you are still holding to? Thank you.
So firstly on specialty care, there are 2 businesses specifically around specialty care, and that one is the Apollo Spectra, which is the short stay surgery models and the day surgery model, and the second one is the Cradle, which is the birthing center. We have seen a very significant increase in utilization in the day surgeries and the short stay surgery model this quarter, and this has helped us in our overall EBITDA for the quarter. As you know, both these models have a significant fixed costs in it, including lease rentals, etc. And we are quite sure of getting the utilization even higher from here on to be able to then start contributing positively to the EBITDA over time, which is the next 2-3 quarters. The utilization in Cradle currently is a bit lower at 45%, but there is clearly a plan to take it to 60-65% in the next 2-3 quarters. The Spectra, of course, is doing at the utilization is over 50% now, and that also has good potential to grow even from here on, because all of these have a lot of OTs in them, and as the model picks up, you will see that the operating leverage will significantly keep kicking in. And with that said, in the diagnostics business, we are still on initial rollout because there is still some rollout cost which is there, because of which obviously while the revenues are growing at a healthy 33% pace even now, there have been some rollout costs of collection points, centers, etc., which are still initial, and we are ensuring that we don't roll it out in such a fast manner that the EBITDA gets impacted, because we have committed that we will get to EBITDA break even by FY20 for this for Spectra as a whole. And yes, we are looking at hopefully by first half of FY20 to get there. This year, as you have seen, we are already at a 19 crores EBITDA number for Apollo, 19 crore EBITDA loss number for the first quarter, and the plan is to hopefully get to between 65 to 70 crores as we end the year.
Okay. Thank you. Thanks a lot.
Thank you. The next question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Yeah, hi, good afternoon. Just clarity on previous question. For break-even at Cradle and Spectra, what utilization you need?
Because the utilization actually for this can be quite, because given that it is, especially in the Spectra model, it is more of day surgery, same-day discharge, etc. The utilization of the OTs that could be, today the OT utilization is 35%. The OT utilization at 50% will become profitable, for the Spectra. When we said 50% utilization of beds is what I meant when I spoke of at the start. So 50% OT utilization will make it profitable. And beyond that, you will certainly see all of that flow down to the margins.
And what about Cradle?
Cradle, also would be approximately around 55% is what we think it would be at it would become break-even.
So you saying that over the next 2 quarters you can take it to 65%, so you expect Cradle to break even before end of this year itself?
So first Spectra would become break-even by end of this fiscal. That is the first thing that we will definitely get to, even before the end of the fiscal. Cradle also we have plans to make it break-even by Q1 of next year.
Okay. So then, see, because your larger losses are sitting at specialty care itself, then largely you guiding that by first half you should break even in AHLL.
So that is what is our aim, so first half is what we are aiming for. So, that is exactly what we have said and we are planning to see, and we are also working on cost optimizations, etc., to figure out how we can bring that, closer to the break-even by first half next year.
And on the diagnostic business, when you mention about rollout, this collection points, or let's say, do you follow a franchisee center over there, or you have your own investment in this all collection points and franchisee? I'm sorry, is it franchisee model or you have your own collection points?
So we have both the models. We have our own models as well as franchisees, and we are now moving with the franchisee model. In certain core locations, we started with our own centers, and now, while we are expanding, we are now using the franchisee model, which is where you will see that you will not see so much of burn happening as we grow these collection points.
Okay, that's helpful. I have one question on the new hospital segment. Now, if I just exclude Navi Mumbai from that new hospital segment, we roughly have about 1,200 beds over there. I just have a couple of queries on this. One is, what percentage of this 1,200 beds today are EBITDA positive? Or vice versa, what percentage is not EBITDA positive? Because I'm aware Jayanagar and Managram were always EBITDA positive. So what else is...
Leaving two hospitals, the others would be profitable, Nasik would be one which would not be profitable still, and Mumbai is not profitable. So leaving Mumbai, we have now become profitable again as we speak. In July, it has broken even as well. So, it's leaving Mumbai and Nasik. The others are already on...
And Mumbai is already, this month, it's from June onwards, it's been profitable.
So, effectively now leaving Nasik, which will be how many beds? 200 to 50?
125. 125 beds.
So largely we are profitable in all the hospitals in Navi Mumbai. It's just that the margins at each of the hospital is very low, which gives us consolidated margin of high single digit.
You're right.
Yes.
And so what's the plan here? For the utilization here has been ramping very slow. So let's say 4 quarters down the line or year down the line, what kind of inpatient growth are you seeing over here? Are you seeing like a double-digit inpatient growth here, high single-digit, low single-digit?
So we will see double-digit. As of now it is 23 because obviously we still are seeing very good traction in New Bombay, but we are still confident of doing, high teens growth in this business even as we move forward, which is what we are pushing for. There are certain, within this, of course, there are 1 or 2 facilities, as you rightly said, like Vanagram in particular, which is, also gotten into double-digit EBITDA margin.
Sorry, your comment on high teens growth is for Navi Mumbai or is for the entire news hospital?
The cluster.
Well, I think the whole cluster will move into double-digit growth. It's now that, they have their doctors in place, it's, it will take 1 year for it to do that.
Sure. I'll join the queue. Thank you.
Thank you. A reminder to the participants to please limit your questions to 2 per participant. If you have any further questions, you may come back for a follow-up. The next question is from the line of Prashant Nair from Citigroup. Please go ahead.
Hi. Good afternoon. So my first question is on the government's proposed national plan, healthcare plan. I think we've heard that there's been a disconnect in the pricing that industry is comfortable with and the government proposes. Have we come closer to some kind of agreement there, or are we still quite far apart?
I think we're getting there. We have had detailed discussions with officials of Niti Aayog, and we have told them that, that we need to, that they need to make some compromises. So we have shared the details of a cost study with Niti Aayog, but simultaneously we have commenced work on differentiated cost models and pathways to increase our internal preparedness so that we can offer a certain number of beds for this scheme, and most of them will be in the Tier 2 and Tier 3 cities. So we believe that on a marginal costing basis, we don't think we will lose any money.
Right. And my second question is, so if I take your network of hospitals and try to split, them between, say, hospitals which, in your view, are already at in terms of getting to a certain level where margins...
I'm sorry to interrupt. Mr. Nair, your voice is breaking.
Yeah. Voice is breaking.
Okay. All right. I'll try again.
Mr. Nair, your voice is breaking. We can't hear you.
Okay. Maybe we should move to the next question.
Sure. We take the next question from the line of Kashyap Pujara from Axis Capital. Please go ahead.
Yeah. Good afternoon, everyone, and thank you for taking my question. Congrats to the management of Apollo for a great set of numbers, pretty broad-based. You had mentioned on your earlier calls and this one that we are reaching to the end of the CAPEX cycle, and the focus would be on basically, utilizing the assets that have been created going forward. Having said that, I have one question on the capital employed. If I look at the return on capital, the existing hospital assets and the pharmacy, both are doing very healthy return on capital, over 15%. And there are a segment of investments, which is new hospitals, the CWIP, and some other investments like AHLL, etc., which comprises half the capital employed, which is yet to earn meaningful returns. Now, given that the capex cycle per se has come to an end, the focus is on utilizing existing assets. How do we see, a blended return on capital over the next few years? What is the roadmap that you have in mind about, by when we can actually see blended 15% ROCE on the company?
So I think, you're right. One is, yes, even on the healthcare services existing, we are aware of this split, and obviously we have provided that also so that you understand that we are working on two things. One is, the existing healthcare services itself, there is still headroom for growth, which is there in the existing healthcare services, which itself currently at 18.5% ROCE has the potential to get to 22% over a period of next 2 years, which is exactly what we have, which is one point that we are working on. Standalone pharmacy, as you know, that currently is at a 4.7% EBITDA margins. We have planned to take it to almost around 6% over the next couple of years, and that at 6% it will be a significant ROCE at almost around 22-24%. Which is a significant ROCE which can come from there. Healthcare services new, obviously our whole perspective is first to get 100 crore EBITDA overall from this business, from the current numbers where we are at 10 crores run rate, which is 40 crores for the year. Our first focus is to get this to 100 crore EBITDA, and then the potential to get to 300 crores over time is real. So this is where we will get to almost around 12 to 13% ROCE in the next 3 years, which is what is the focus. So clearly, we are focusing on all the three areas, separately, and you will then realize that overall, as the ROCE for the company would be very, very healthy.
So I completely agree, because the hospital model clearly has a 15-20% ROCE on a sustainable basis as a hospital by hospital basis. So if the capex comes to an end, broadly the company should end up moving closer to that target over time. Now this 12 to 13% ROCE you mentioned for the block of new hospitals?
Yes.
3 years?
That is right. That's exactly what we are aiming for.
Okay. So the current hospitals which are existing and the pharmacy moves to 20-ish, and the new hospitals comes to 12 to 13% over the next 3 to 4 years.
That's right.
So which means that we will go back to the phase of 15-20% earnings growth that we reported, for 30 quarters in a row. We might just be getting into that phase because it's all about growth and utilization.
So it's a combination of both, right? One is the growth, and other is also cost optimization that we are working on internally, which is the other thing that you would see us, because especially given that we have, as you have seen, that there is a significant number of hospitals that we have within each cluster now, including Chennai. So we are also figuring out how we can optimize on resources, how we can ensure that the resources in the Chennai main hospital is also used in other hospitals. So some of that work has already started, and as we said, our whole focus now is just operating leverage and ROCE. So it will be a combination of both growth and margin expansion. It may not be only growth. It will be a combination of both.
Great. That's great. And finally, which means that once the CWIP, which is, the announced capex which are yet to go through, like Proton and etc., once they are done, then like from FY20 to 23, we should be able to see, meaningful reduction in debt purely from internal cash flows, given that capex intensity won't be as high.
On a lighter note, yes, I have not put the expansion slides from this quarter. I'm sure you have noticed, because we don't have any expansion plans. So clearly, it's only the proton therapy which is there, and which is the 350 to 300 crores, which is the balance capex which is there. And apart from that, there is nothing much which we have plans for. Even the Bombay hospital is going to take at least 2-3 years, before which time we will start seeing good cash flows to come.
Free cash flow to fund it.
Yeah, great. That's great. Look forward to seeing that, and wish you all the best of luck.
Thank you.
Thank you.
Thank you. The next question is from the line of Chandramouli M. from Goldman Sachs. Please go ahead.
Hi, thank you for taking my questions. The first question is on ARPOB. We've seen a steady 6 to 7% growth across your key home markets, Karnataka, Hyderabad, Tamil Nadu. So can you just provide us some perspective on how you've been able to drive such impressive ARPOB growth YOY at these three key clusters?
Yeah, this is a combination of the case mix where we're looking at our centers of excellence to contribute more, and we've seen a healthy growth during the quarter on the centers of excellence. That's contributed to a higher ARPOB. And the second is the choice of patients that we take in. We have taken a conscious decision to take in, not take in patients where the tariffs are below a certain level, or minimize the number of beds that we allocate to that. So both these put together have actually led to an increase in the ARPOB.
Thank you. Thank you. That's helpful. The second question is on standalone pharmacies, kind of on similar lines. EBITDA per store seems to have grown much more than revenue per store. So it looks like there's some kind of efficiency benefits happening in there. Could you just give us a little more perspective on that as well?
Straightaway case where volume growth is now contributing to the EBITDA. We are still growing at about 20% plus on the revenues. So we should continue at that rate and contribute significantly going forward to the EBITDA growth.
All right. Thank you. I have more questions. I'll join back to you.
Thank you. The next question is from the line of Neha Manpuria from JP Morgan. Please go ahead.
Thank you for taking my question. My first question is on Navi Mumbai. If I look at the beds, we have been at about 125 beds in terms of occupancy. Now, if we were to add more beds to the existing operational capacity, do you think we will be able to maintain our break-even target, or there is a risk that gets delayed as we add new beds? Particularly, these would require improvement in specialty mix in that case.
Addition of beds is being done based on the current occupancy levels and the likelihood of the new beds being occupied. It's been done in a very measured manner to ensure that it doesn't impact the break-even target set for the Navi Mumbai facility. So we will ensure that the expansion happens in line with what has been projected in terms of the EBITDA margins for the facility.
And even now as we speak, the resourcing and the staffing that we have is for a higher number of beds of almost around 175 occupied beds as compared to the 125 that we have.
Yeah.
Okay. No, the 125 number is the total occupied beds, right? The total beds commissioned is about
140.
Right now, today it is about 140.
Okay. And would this number go to about 300 beds in the next, let's say, 1 to 2 years? Or would it take longer for you to ramp up?
No. I think definitely by year 2.
Okay. Fair enough. And my, second question is, ma'am, you mentioned that there are a lot of cost efficiency programs that you have in place for Chennai and Hyderabad, essentially to allow you to operate at, at lower price points. Does that mean, that should give you, better margins even in the existing hospitals, right? Because these are standard procedure that you could, roll out through through your network. When do you see that happening on an existing base, hospital network basis, assuming, the environment remains tough? Can we still see margin improvement from these initiatives? And two, do you think that, participating selectively in Ayushman Bharat could impact how Apollo is perceived, as a premium service provider to your existing patient pool?
So to your first question, I think we can only see margins improving. We've shown 143 basis point improvement in margins. And going forward, we believe that with this cost optimization, we should be able to achieve somewhat the same every year. So we're clearly on track. We've started in Chennai and Hyderabad, which are our two biggest geographies, and we'll take this across India. To your second question on NHPS, I think it's important that we participate with the government because it's a lot of give and take between the government, and hopefully that we expect that they will also do things that are good for the sector, because they will realize that infrastructure is key for them to deliver on their promise. So in Tier 2 and Tier 3, where we have capacity and we have the ability to do so, I'm sure that it will make a positive impact on not just the government but on the brand.
Ma'am, how much of the capacity is in Tier 2 and Tier 3 city out of the 7,000 beds that we have?
So you'll have to come back to you on it. Is part of the others, obviously. It's maybe around 50% of the others capacity.
Okay, sorry. Thank you so much, sir.
Thank you. The next question is from the line of Swati Madha from East Capital. Please go ahead.
Hi, thank you for taking my question. I had a question regarding the volume growth. So it has been pretty strong for the Tamil Nadu cluster and also for the Hyderabad cluster, but a little weak, but weaker for the Karnataka cluster, I guess. But is this just base, or are you seeing some other structural factors that people are healthcare spends going up, or are you gaining market share? Is it just base effect, or are other factors are at play?
If you look at our cluster, Karnataka cluster, we have 4 hospitals, 3 in Bangalore and 1 in Mysore. The one which has seen a lower revenue per patient has been in Mysore because there are some corporates there where the tariff structure is much lower than our Bangalore hospitals. While the Bangalore hospitals have all shown an uptick in the ARPOB, it's only the Mysore hospital which is contributing to a dip in the ARPOB, and that's reflecting on the entire region.
Yeah, I mean, I was just talking more about the inpatient volume growth in Tamil Nadu and Hyderabad. That's been very good. Is it just base, or is there any structural change with respect to market share or healthcare spend?
I think one is there has been a lot more focus on certain segments of the market, particularly the insurance and the private sector market, which give us good margins. The volumes in these 2 segments have improved, and the walk-ins have improved. And for Chennai segment, the international patient sector has contributed significantly to the growth.
Okay, so the international patients are coming back now.
Yeah.
Is it from the Gulf mainly?
No, it's from multiple, all our traditional markets like Africa, Gulf, and other countries in the subcontinent.
Okay, understood. I had one clarification regarding the Lucknow acquisition, right? So I think earlier a question was asked whether if there is any incremental capex needed, and you mentioned that for Lucknow, no. But you also talked about Bihar and Jharkhand. So
No, we said that the Lucknow hospital will provide drainage. It will become a referral center for Bihar, Jharkhand.
Okay, understood. Thank you for clarifying that. And Proton starting date does it remain the same?
December, January.
December, January. Okay. And Gleneagles has also shown good improvement. Like now it's breaking even.
Yes.
Do you have any guidance for Gleneagles for the year?
So I mean,
they continue to do well.
They will keep up the momentum that they've shown in the first quarter, and they should improve by the last quarter.
More years to reach back the old market.
Yeah.
Okay.
But with the current government in place, it will take 2 years to reach what it was in 15-16.
Okay, understood. Just last question, please, on AHLL. So you were mentioning, do we understand that you will not be opening any more Cradles or Spectra till you attain some kind of EBITDA margin? Is that something we can...
Yes, I think that's a correct assumption.
Okay, is it going to be EBITDA break-even, or is it going to be a certain level of EBITDA margin? Or if you just break-even and then you'll again start adding more, or...
No, I think we have to see some EBITDA margin.
Okay. Okay, understood. Understood. Thank you so much.
Thank you.
Thank you. The next question is from the line of Rohan Dalal from BNK Securities. Please go ahead.
Yeah, hi. Thanks for taking my question. So I had a question on the operating profitability. I just wanted to understand whether the margins that we see this quarter, which were really good, will they sustain for the year, or will there be any dips in the new hospitals? And also on that point, AHLL, was the guidance for EBITDA break-even or PAT break-even?
So on the EBITDA margins, we are quite confident that we should be able to maintain it at the current levels even as we move forward. And obviously, the focus is to grow it also in new hospitals, next 2 quarters. And even in the existing hospitals, we are looking at certain cost optimization opportunities, etc., which should again help us. So clearly, it is sustainable. And on AHLL, it was EBITDA break-even. It was not PAT break-even.
Fantastic. So, thank you.
Thank you. The next question is from the line of Charulata Gaidhani from Dalal & Broacha. Please go ahead.
Hi, congrats for the good set of numbers. My question pertains to the Karnataka.
I'm sorry to interrupt, there's a lot of static noise coming from your line. Maybe request to use the handset, please.
Is that okay?
Yes, better.
Yeah, okay. My question pertains to the Karnataka region. Why is there a degrowth in volumes, and is there any specific reason for that?
No, there is actually, if you actually look at it, there is no degrowth in terms of the patients with a tariff which gives us a good margin. And as I told you, we were very conscious about generating margins more than the volume, so we did take off some of the low-paying corporates which are not providing us the margins. That was one. And the second one was, as I just told you, Mysore was one where we saw a degrowth in the volumes, which reflects, which actually adds up to the Karnataka region.
Okay. And overall, are you seeing a lower volume growth compared to the previous years?
No. We've seen significant growth in Chennai cluster, in the rest of hospitals in Bangalore, in Hyderabad. We've seen volume growth, double-digit volume growth.
Okay. Yeah, fine. And with the Ayushman Bharat coming in, you think?
I'm really sorry to interrupt. There's a lot of static coming from your line.
Okay, is that better?
Yes, it is better, but that static comes. Can you please use the handset?
Yeah. I am since there is a lot of... Yeah. Is that fine?
Yes, please go ahead.
Okay. Yeah, with Ayushman Bharat coming in, do you think that there will be a pressure on ARPOBs coming down, or, will there be a pressure on occupancy in terms of the high-margin business?
No, I don't compromise the high-margin business with Ayushman Bharat. It will be mostly in, we do have Tier 2 and Tier 3 cities, we can do it. And we'll actually, we'll cap the number of beds that we could do, because it's a learning phase for all of us.
Yeah, right.
Without risking the main strategy.
Right. Okay. All the best.
Thank you.
Thank you. The next question is from the line of Nitin Agarwal from IDFC Securities. Please go ahead.
Hi, thanks for taking my question. So on the improvement of profitability which is there in the existing hospitals, you talked a bit about the cost optimization measures you've taken in Chennai and Hyderabad. Can you just throw some more light on the kind of measures that you're talking about, and what kind of incremental potential some of these things have for these clusters as well as for the network per se?
Yeah, it's not a single measure that we can tell you on this call. It's a combination of measures. And as an example, I can tell you we started kitting for surgical procedures. That means that we create a kit and give it to the operating team. to make sure that there is no wastage of material used for a particular procedure. That's just an example, but we are working on multiple fronts in each of the hospitals, including materials, including pharmacy, including human resources on all fronts. And there are multiple projects which are in progress at this point of time, and we're seeing good results to begin with. And we are hoping to take this, not only sustain it in Hyderabad and Chennai, but to take it across these learnings to the other units in the country.
Okay, perfect. And secondly, on these mature hospitals, so I mean, seasonality-wise, where is Q1? Q1 is the Q2 and Q3 are relatively bigger quarters for us, right?
Q2 will be better, yes.
So ideally, we should see a sequential pickup in the EBITDA contribution from these newer in the older hospitals as we go through the year.
Yes.
Okay. And secondly, on Lucknow, while we are obviously looking to consolidate now with the expansion that we've had in the past, but I think there is a lot of turmoil in the hospital sector in general across the country. So what's your sense in terms of when you are looking at assets, probably evaluating assets incrementally in terms of whatever proposal evaluation you're doing, has the competitive intensity in terms of bidding for assets gone down? Are there a lot more attractive deals on the table than they were probably 2-3 years back for you guys?
Yes, definitely. There are a lot more attractive deals at a good price available.
And that is largely because the PE interests have gone down, or it's probably competitors are most of the...
No, I think that we predicted this a long time ago, that, individual doctors setting up hospitals is quite challenging. I speak from my own experience, but having an experienced managed team is key for sustainability, and I think that we've managed to get that right. And also having doctors on board, a multiplicity of doctors, a pipeline of doctors that will move, which will provide clinical differentiation every year.
Fair enough. And just to go to the point, presumably if opportunities like, for example, the Lucknow opportunity come your way, I mean, we still would be open to evaluating those things on an objective basis, right? Or for us, it's a short case for the next...
I think it's on a case-by-case basis, but I think we've almost completed our geographical footprint, so you won't be seeing any big capex or investment from us for some time.
Okay.
Thank you. The next question is from the line of Nitin Gosar from Invesco Mutual Fund. Please go ahead.
Yeah, so on Ayushman Bharat scheme, just wanted to understand how will the list work? Like you have a typical empanel list of hospitals where a patient can get operated. That's the way typically the medical procedure functions. But in this case, you are saying you will be more selective in being available in Tier 2, Tier 3 and not in metros and Tier 1. Is that the way?
So I think, one, we're allowed to make a choice whether we want to empanel ourselves, and I think we're clear about that. Second, unit by unit will be empaneled, and so while we will empanel Karakhadi or a Trichy, we will select, but we first need to see the details of Ayushman Bharat before we come out with our own strategy on which hospitals we'll empanel.
Okay. Just a minor bit more on this. So, do you have some kind of analysis on how a patient behaves or how the brand behaves if there is a selective empanelment in terms of negative publicity? If a patient is coming at doorstep and if there is any denial for admission, that may lead into some kind of escalation of...
No, we'll just have to say, that these are not empaneled to do it.
So when the unit is empaneled, we will empanel the entire unit. It is not as though we are going to be selective within the unit on patients.
I got the point on unit by unit call. My understanding was more on the corporate image, how if this...
Actually, we are already doing it for some of the state government schemes. For example, in a place like Hyderabad where we have 4 facilities, one of the facility or 2 of the facilities are empaneled for the government schemes, while the others are not. So we're not refusing a patient, but we are allowing the patient to use a facility which is empaneled. So we will not get a negative image in the community.
Got it. Perfect.
The government also understands this because this is at the, the rollout and the implementation of the NHPS also is going to be at the state level. Because while the program is going to be at the center, it is going to be, a state level rollout and the state level reimbursement. So clearly, state governments understand this.
Okay. And second question is pertaining to the retail pharmacy. Where are we in terms of penetration levels, and when is it that the management will take a call on monetizing those assets?
So it's early time still, because if you look at it, currently we are at, as we said, we are continuing to grow this. The potential for the pharmacy growth is very real, and we are continuing to look at a 20+% growth for the foreseeable future. The number of stores from 3,000 can become even 6,000 over time. So clearly there is a plan, and the EBITDA margins can go to 6%, ROCs can be higher. So we have said at the right time we will monetize it. We will come with a structure to help us do so as well, and take it forward from there.
Just to add on to what Krishnan said, we're also looking at a digital strategy to expand the number of consumers that we have.
And how we do that? Like, is it online pharmacy that we are targeting?
Yes, something like that, yes.
Got it, ma'am. Thank you.
Thank you. The next question is from the line of Kumar Saurabh, an individual investor. Please go ahead. Kumar Saurabh, your line is unmuted. Please go ahead with the question.
Hello, can you hear me?
Yes.
Yeah, thanks for the good results and the operating leverage stories playing out. I have two questions. One, last quarter we thought that debt is going to be maximum debt, but now also the debt has increased. So is this the peak and now we can expect the reduction? And second, on the pharmacy space, what we see is like Amazon is planning to buy one of the competitors. It looks like there could be some structural change in terms of the offline-online model. So what is your long-term view about this whole pharmacy structural model, how it will play out, and what are your plans?
So on the debt level, yes, the capex which is fine, the balance is still there, the 350 crores of Proton. So that would take the debt to the peak level, and after that it will start coming down. The second point about pharmacy, over what?
As Mrs. Reddy just said, we are preparing ourselves for our plans on the digital platform, and we are prepared for that.
Sure, thanks a lot.
Thank you. The next question is from the line of Sayan Mukherjee from Nomura. Please go ahead.
Yeah, thanks for the follow-up. One question I had on the volume growth. I mean, in one of the response you mentioned that, you're seeing good volume growth in some of the hospital double-digit. But, the numbers that, we see on the presentation, like in Tamil Nadu, 4.3%, Telangana, 3.9%, and in Karnataka there was a negative growth in the inpatient volume. I understand this is maybe because, you are focusing on high-value patient and there is some kind of a rebasing which is happening. So, I mean, when the base effect comes in play, do we see double-digit volume growth, let's say in fiscal 20? Is that a right assessment, first of all?
Yeah, actually, if you look at our current quarter also, you would realize that there is a significant movement, change in the way the patients are being treated currently. Number of them who are being treated as inpatients are now being treated as outpatients and as daycare patients. So when you actually put those things together, you would see a double-digit growth in the current environment also. But as we go by, I think a double-digit volume growth is very much on the cards. Okay,
great. And the second question on margin. Now, if you see the existing hospital which has been in operation, you're doing like 21% EBITDA margin. How is the spread like? Let's say if you take 3,000 odd beds, old beds that you have. What's the spread? What is your the maximum EBITDA that you generate in a hospital, and what's the lower EBITDA margin? What's the range?
It would be between 18 to 26.
18 to 26. And, if I look at your cost items, it seems like, though the margins have expanded, the material cost to sales and employee cost to sales, have remained steady. I mean, they're growing in line with the total revenues. So is it the other expenditure item where you have a lot of these initiatives which are able to give you that leverage?
No, even in these two, we have had the leverage, definitely, because, one is, it will not exactly show up in the overall P&L, because at the unit level, you have the benefits which are there, because if you look at the unit of especially in the mature units, because some of this, when you see at an aggregated P&L level, has the new units also, hence you're not able to see that impact of EBITDA margin expansion. These existing units, you would be able to see that. It is actually in the material and in the manpower.
Okay, you're seeing that. Okay.
Yeah.
Okay. And I mean, one expense like doctor expenses, right? When you were opening up these hospitals, they were ramping up much faster. So now, the total doctor expense increase, let's say for this year on a standalone basis, is it possible for you to share what's the kind of increase year on year you've seen in this quarter for doctor expense, so that I can
actually the guarantee amount keeps coming down as the hospital matures. Okay. So it's highest in the first 2 years of operation.
Okay, so ma'am, so if you have a 15% revenue growth, the doctor fee increase would be lower than that. That would be a right assessment?
Yes, in the new hospitals, yes.
Okay.
Mr. Mukherjee, do you have any further questions?
No, I'm done. Thank you.
Thank you. The next question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Yes. One question on Chennai main hospital. Question is, first of all, what is the utilization that we're doing there?
62%. 62%.
And this is lesser than last year. I remember last year we were doing about 54% or thereabout, right?
So, I have two things in Chennai. Main is the ALOS has also come down. The average length of stay now in the Chennai is almost around 3.2. And even we have started using a lot of daycare.
30% of our procedures are now daycare. And also we've moved out the gynec, which is into mother and child hospital.
Okay. So, but let's take this 52%. Among the different specialties...
52.
Yeah, 52, right?
62.
62%, yeah.
Okay, that's why I got it wrong. And ma'am, just the spread on this 62% among the different specialties, is there anything which is really dragging it down? Or is it like, do we have any specialty where we are 50% or less?
Actually, it would have been more than 62% if you take it on your quarter-to-quarter basis with all the factors remaining constant. But what happened is we moved out the mother and child from the main hospital to the mother and child hospital. So that was a significant volume which moved out from there. And that is why you're seeing a 54% to 62%. Actually, if you had the mother and child in place, it would have been around 66%.
Okay, understood. And second question is on Proton. Once we started, how many years will it take us to break even that unit?
So Proton, the Proton facility itself should will break even in 18 months. Only the Proton, as the equipment. The hospital will take 2 years to break even. But we don't anticipate huge losses coming out of the facilities.
But if you combine the two, what kind of EBITDA loss are we talking about? Let's say, just to put a number to it, let's say, are we talking about annually 30-40 crore kind of number or just 10-20 crore kind of number?
It won't be it should not be more than 20 crores.
Both beds and equipment put together?
Yes.
Okay. And last question is on CAPEX. How much CAPEX we done this quarter?
So this quarter, CAPEX was almost around, if you decide, what is the project CAPEX, Krishna Kumar? Can you take this offline? We'll provide this number because I have the recurring CAPEX is almost around 55 crores, which is the routine CAPEX that we have, and that should, and the routine, the new CAPEX is not something that I have offhand, maybe around 60 crores.
See, I was asking because our debt increased by 130 crore in this quarter It
also includes Lucknow acquisition.
Oh, that's already paid 90 crore over there?
Yes.
Yes. Okay, sure. Thank you.
Thank you. The next question is from the line of Chandramouli M. from Goldman Sachs. Please go ahead.
Hi, thanks for taking my follow-up. So the first one is on prices. I was wondering if you've been able to take any price increases in the market at the start of this quarter?
Yes, we have around 3%.
All right, thanks. And just the last one is housekeeping on CapEx. So it looks like we've undertaken, you just mentioned the 55 crore recurring CapEx this quarter. So a Proton plus maintenance CapEx included, what would be the outlook for this fiscal year?
So maintenance CapEx, as we have said, it should be between the 150 to 170 crores range, which is what we would continue to be on. And the Proton, as we said, the balance should be 300 to 350, because there are certain equipments which are being looked at, and so it should not be over 350.
All right. Thank you so much, and all the best.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
Thank you, ladies and gentlemen, for joining us. Today, as you've seen, Apollo has a consumer base of 25.4 million consumers. Not only do we stand out as a clinical differentiator, but we challenge ourselves by creating the entire ecosystem from clinics to daycare to hospitals and pharmacies. More importantly, what we are doing today is to build the digital backbone that will enhance the stickiness of not just our patients but also our consumers. This, I believe, will be disruptive for the sector, and we look forward to having you in the exciting journey that we see ahead. Thank you, ladies and gentlemen.